Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. In today's episode, we're going to be talking about the bucket strategy. It's a way to think about investing during retirement and how to sort of allocate your investments. It's a topic that we discussed at length when I interviewed Christine Benz of Morningstar. She's a big proponent of the bucket strategy, and I was too at one point, but the more and more I study it, the more I don't like it. So I have a very different view than she does. She's given obviously a lot of thought to it. She's written a lot about it. So I highly recommend you check out her work to get a very different perspective. But this came up when a viewer emailed me the other day. Let me read you his email, and his username is USA Hicktown. So, my kind of guy or gal. Anyway, Rob Berger, how did you conclude the bucket strategy is worthless? Please provide details. Thanks. Now, my first reaction to that was, did I really say it was worthless? I actually think it's worse than that, because I actually think it can lead us down a path that can hurt us long term in retirement. It's kind of the worst of both worlds. It can make us feel safe while at the same time exposing us to far more risk than if we said, forget the bucket strategy. Let's just have a 60-40 portfolio and rebalance every year. So that's what we're going to talk about. I'm going to explain why I feel the way I do, why I believe what I believe. I've got some research to show you. I've even got my digital whiteboard out so you can see just how bad my handwriting is. And so that's what we're going to do. And we're going to start with, I think, placing the blame. And the blame clearly belongs to Harold. And you may say, Rob, who's Harold? Harold Avinsky. He's a financial planner. I've never met him, probably a perfectly nice guy, but he's the one that actually introduced the bucket strategy all the way back in 1985. And when he introduced it, there were just two buckets. You may have heard of a 3-bucket strategy, I think, which is what a lot of folks talk about. But when he first introduced it for his clients, he had a 2-bucket strategy. And to kind of give you an idea of how it worked, I'm going to show you sort of how these two buckets interacted with one another. But I want you to keep one thing in mind. The idea behind the bucket strategy, as he introduced it, and as a lot of people, a lot of proponents of it talk about it today, it was to accomplish what they viewed very important thing, and that was to set folks up in retirement so then when the stock market is down, think earlier in 2020, or we can go back to 2008 and 9, you don't have to sell stocks to fund your living expenses. You'll have this bucket of safe money you can draw from until the stock market gets done falling like a rock and hopefully turns around, and then you can start taking from the stock market bucket. That's the idea, the concept behind the bucket strategy. Now let me show you how Mr. Avinsky's bucket strategy worked. And like I said, his only had 2 buckets. So we can imagine, I don't know if this is going to look like a bucket. Does it look like a bucket? I guess it does. So this is our cash bucket, and so far, I'm very proud of my handwriting. I just want to say that. Not bragging or anything, but I can read that. That says cash. And what he would recommend is 5 years worth of expenses. So let's assume our expenses each year for our purposes are $40,000. So you would have $200,000 in cash. And if we just think about it sort of practically, that could be a checking account for some of it, maybe a high yield savings account. But this is cash, right? And then the second bucket is basically mostly stocks. Right, so that's going to be all the rest. So if we want to imagine, say we have a $1 million portfolio, using this setup, we would have 800, try that again. There we go. We'd have 800, see my handwriting's getting worse. We'd have $800,000 in this stock bucket. And the idea is, if we imagine, let's say after 1 year, we've spent 40 grand, so we're left with 160,000 over here. And let's imagine that the stock market crashed or whatever, went down. It doesn't even have to be a crash, really. Let's say our stock bucket is now worth 700. It's gone down by 100 grand. The idea would be, no worries, we'll leave this alone, and we'll just continue to spend out of this bucket. And heck, the stock market might go down again, but it's unlikely to go down 5 years in a row. So that's sort of the idea. This cash bucket is our cushion. This is the this is what helps us sleep at night. Now, that in and of itself is certainly important. There's, a whole study of behavioral finance. And I think, having now sort of entered at least part-time retirement, I guess, it's really important in retirement, because when you're living off of your investments and the stock market goes down, that's a scary time. And so this cushion is important. But what Mr. Avinsky has set up creates a number of problems. All right. Now, what are they? Well, the first is, notice that when we look at this right here, the first year, we have 40,000, we've got 200 in cash, we've got 800 in stocks. So what does that make our stock allocation? Well, it makes it 20%, I'll call it fixed income. You can think cash and bonds, and 80% stocks. For a lot of folks, that's way too risky in retirement. And in fact, if you've watched my videos on the 4% rule, which was developed by William Bingen, you know that what he recommends is an equity allocation somewhere between 50 and 75%. Anything below 50% in equities runs into problems when we have high inflation. And of course, stocks in the short term can do very poorly in high inflation, but longer term, they tend to do better. But when you have high inflation, it can really eat away at bonds. So you've got to be careful about having too much fixed income in a portfolio. But on the other hand, you don't really want to go above 75%, because if you do, and we have another 1929, or certainly a 73 to 74, very bad markets, the latter having a lot of inflation, you're going to get into trouble there as well. And so what his research has found, and it's pretty much been confirmed over and over again, more or less over the last 30 years or so, is that you really want an equity allocation somewhere between 50% and 75% if you're going to follow something along the lines of the 4% rule. And if that's all new to you, I highly recommend you check out my series on the 4% rule. You can find that on the channel. There's a playlist for it. And so you can see here, this is a little too rich. And what some folks will even do is actually make it worse, because some folks will say, look, I don't really need 5 years in cash. I only need, say, 3 or 2. Well, that lowers the cash amount and increases the equity amount. And so this could end up being something closer to 10% fixed income and 90% stocks. And that becomes even a more problem, bigger problem. So that's the first issue. Now, there's ways to address it. We'll talk about that, but that's the first issue. The second issue, I think, is maybe even more fundamental, is that when stocks go down, like they did in this hypothetical, they went from our balance went from 800,000 to 700,000. What should we as investors do? And this is true whether we're accumulating money during our working years or we're hopefully slowly, spending it during our retirement years. What do we want to do when the stocks go down? Well, we want to buy stocks, right? And that's effectively, or it is what we do when we rebalance, say, once a year. If stocks are down and we rebalance, we end up taking money from our bonds and other fixed income to buy stocks. And so by rebalancing once a year, we're effectively buying when the market's down. And if the stock market's up, we're selling to rebalance into bonds. Well, with what Mr. Avinsky set up, this doesn't happen. We just sort of ignore the stock bucket when it goes down. And so that's the second problem. The third problem is, what are the decision rules around this? For example, let's say in year 3, the market's up, but not a lot. And so after the end of the second year, we're at 725,000. Well, that's certainly above the 700 from the year before, but it's still well below the 800 where we started. Now what do? Do we start taking from the stock bucket, or do we wait until it goes above 800,000? You see, you have all of these sort of decision rules that you have to figure out when you're going to go from one bucket to the next. Now, some have tried to sort of solve this, and I think in trying to solve it, they've actually made things worse. And let me show you what I mean. We're going to clear this page. What some folks have said is, oh, don't worry, Rob, we can solve all this. We're going to actually just do 3 buckets. That's the first part of the solution. So we're going to have cash up here. You can think fixed income, or we'll just call it bonds here, and then stocks here. And what they say is, let's have, we'll call it 2 years here. It could be a little more or a little less, but 2 years in cash. We'll call it 5 years in bonds, and then the rest of it here in stocks. And so this actually, they will argue, gives us even more cushion, right? Because now we've got, to the left of that line I just drew, we've got 7%, 7 years worth of spending in obviously ultra safe cash. And assuming we're investing in, say, US government, relatively short to intermediate term bonds, we've got an extra 5 years. So we've got actually even more cushion. And we can allocate between the stocks and the bonds. And what they would say is, look, if stocks are down, we don't always have to go from stocks to bonds in terms of flow of money and then bonds to cash. This was a point Christine made. She said, we can actually go in reverse. We can take some bonds and put it in stocks if, say, stocks are down and bonds are up. But that gets even, in some ways, even more confusing because it says, well, we have to have decision rules. How do we know, if stocks are down 5%, do we then move money from bonds to stocks? And when do we refill the cash bucket? So let's imagine we've got $80,000 in the cash bucket. We've got 40 a year. And then for the bonds, we're going to have 200,000, right? And if it's $1 million portfolio, that leaves us with, I think, 710,000, 720, if I've done the math right. I probably haven't, but you get the idea. Well, what happens if stocks are down to 600 the next year? This is down to 40 because we've spent it. And let's say bonds are at 210. Well, now what do we do? Do we take money from here and move it to there? And then, well, what about this? We're down to 1 year. How do we fill that back up? If we're going to move bonds into stocks because stocks are down, which makes sense, well, we're going to run out of money at the end of the year. We're going to have to fill it from something, right? And so how do we do all of that? You see the complications with a 3-bucket strategy. And as I was thinking through this in my own retirement, I started thinking, well, what am I missing? Everyone just sings the praises of the bucket strategy. So clearly I'm missing something. Well, I've been started to work on a book that my next book, which is going to focus on how to manage your investments in retirement. And it's something obviously very important to me. See all the gray hair. And so I've done a lot of research, and it turns out that my concerns with the bucket strategy are not unique. That a lot of folks have done a lot of research on the bucket strategy, and they've kind of come to the same conclusion. And I want to show you some of that research now. We're going to begin. This is Michael Kitces. He's a financial planner with an excellent blog. I highly, highly recommend his website, kitces.com. You can see here, KITCS. This is an article he wrote all the way back in 2014. And basically what he did, he said, let's compare the bucket strategy to just sort of a total return approach, say a 60-40 portfolio, for example, that we just rebalance every year, nothing fancy. And here's what he concluded. He said, when a decision rules strategy, which think of that as like a decision rules strategy being a bucket strategy with some set of rules to figure out when you're going to move money from one bucket to another, is paired with simple rebalancing, so say a 60-40 portfolio that you just rebalance every year, it turns out that the outcome is no better than merely managing the portfolio on a total return basis without the decision rules at all. And I think I may have misdescribed that a bit. Let me try it again. What he's saying is, when you have a bucket strategy, you have to have all these rules for where the money goes, and you got to have rules for rebalancing. That's one approach, complicated. When you compare it to just, sort of no decision rules at all, you just have a portfolio that you rebalance every year, it turns out that rebalancing alone already has an astonishing, powerful effect to avoid unfavorable liquidations, as the process systematically ensures the investments that are up the most are sold and the ones that are down the most are actually bought instead. Now, if that seems complicated, and if it does, it's because I've not described it well. I'm going to show it to you. So imagine a 60-40 portfolio. So we've got, let's say, we're going to do $40,000 a year in spending, and let's say we have $1 million left over, and we have 600,000 of it in stocks, and we have 400,000 in bonds, right? And we got 40,000 over here in a checking account, and we spend it. And let's imagine we have a bad year in the stock market, and we're down to 500K the next year, and let's just say bonds are at whatever, 425,000. So the first concern is we don't want to spend stocks, right, because they're down. Well, if we just think of this as a standard 60-40 portfolio that we're going to rebalance every year, how would we first fund our next year's expenses? And let's just assume we need, we'll call it $42,000. Where do we take this from? This is the important point. If you're rebalancing every year, so let's imagine December 31st, well, the market's not open, but we'll imagine December 31st anyway. You take out $42,000 from somewhere, and then you immediately rebalance back to, say, 60-40 in our example. Well, in that scenario, it doesn't matter where you take the money from, because you're going to rebalance as soon as you're done, and you're going to rebalance back to this 60-40 portfolio. So we could take it out of the $500,000 in stocks, which would leave us with $458,000, I think, right? And we've still got $425 in bonds. And someone might say, well, wait a minute, Rob, we've just done what you said we don't want to do. We've sold stocks in a down market, but it doesn't matter, because now we're going to immediately rebalance this money, $458,000 and $425,000 in bonds, into a 60-40 portfolio, which will cause us to do what? Well, we're going to have to sell some bonds and buy some stocks, right? Exactly what we want to do in a down market. And that's why I've come to the conclusion that we don't need all these fancy bucket strategies. And in fact, it not only makes managing our money harder, we have to come up with all these decision rules as to when and how much to move money from one bucket to the next. It doesn't really make it easy to buy stocks when stocks are down, which is what we should be doing. And all of this happens without giving it any thought at all when we simply have our basic investment portfolio, whether it's 50-50, 60-40, 70-30, whatever it is for you in retirement, and we simply rebalance every year. And it turns out that Michael Kitces isn't the only one who figured all of this out. Let me show you a few more papers. And actually, I want to jump to this one. This is from a professor, The Bucket Approach for Retirement, a Suboptimal Behavioral Trick. And what he found, I'll give you just the upshot of it all right here. This was in 2018. He said, in fact, simple static strategies, which by definition involve periodic rebalancing, again, 60-40 would be an example, clearly outperform bucket strategies, and they do so based not just on one, but on 4 different ways of assessing performance. That was his conclusion. I want to show you another one. Here we go. This is an article from Joe Tomlinson in Advisor Perspectives. This is from last year, and he actually looked at Professor Estrada's paper, and he didn't agree with everything in the paper, but let me show you the upshot of it. If we go all the way to the bottom here, bucket strategy promotion. He says, and this is the paragraph I'm reading from, he says, I mentioned earlier that the 2 leading advocates for bucket strategies have not claimed the bucket produces superior financial outcomes. Unfortunately, others in the advice profession have not been as restrained. I have seen claims that bucket strategies can reduce sequence of returns risk or have been shown to increase a portfolio's longevity. It might seem logical that a strategy designed to avoid selling stocks in down markets should provide superior financial performance. However, there's no evidence to support such claims. They depend on an assumption that year-to-year stock returns are negatively correlated, whereas the historical data shows virtually no correlation. And finally, this is from Larry Swedroe, very well-known financial professional who's written a lot on a lot of things. And his question, he actually just comes right out, is does the bucket approach destroy wealth? And we can come down here to his conclusions, and he describes the bucket approach, and he refers to Professor Estrada. And he said, Estrada found that a bucket approach underperforms static strategies based on all 4 ways of assessing performance. And he gave what those were. Although the results obviously varied across the 21 countries he examined, those for the average country largely confirmed and strengthened those already discussed in the United States. And he goes on basically to agree with what Estrada concluded. And then he says here, Estrada's results lead one to question why the bucket approach is so popular. He says the most likely answer is that it's due to a lack of knowledge. Estrada's research makes that excuse less defensible. So at the end of the day, I think the bucket strategy is far more complicated to implement. I think it requires us to use decision rules on when to move money from one bucket to the next that really don't have any research to support that that's the appropriate approach. they can cause a stock bond allocation to go beyond what William Bengen recommended. And it's not that William Bengen's equity allocation of somewhere between 50 and 75% is gospel, but I think it's generally correct. And the bucket strategy, if we're not careful, can cause us to go outside of that range significantly, which could absolutely impact the longevity of our portfolio. But here's the real thing. If the goal of the bucket strategy is to keep us from selling stocks when the market's down, why are we even coming up with that solution? We don't need it. Just rebalance every year. If the market's down, you're going to end up selling bonds and buying stocks, which is exactly what we want to do. You're not going to sell stocks. Even if you took your spending money out of a stock portfolio and then rebalanced, the result after the rebalancing is going to be your stock allocation has gone up, again, following a bad market, and it's exactly what you want it to do. If stocks are up, you're going to take your money for the year, probably based on taxes more than asset allocation, and then you're going to what? You're going to rebalance. In the case of a stock market being up, you're going to sell stocks to buy bonds. Again, it's exactly what we want to do. Now, I don't want to be dismissive of the feeling of comfort that we get if we have this from this cash bucket, right? But we can implement that with, say, a 60-40 portfolio very easily. Simply take your 40% in this hypothetical of a fixed income and put as much as you need to feel comfortable in your checking account, or a combination of checking and savings, or possibly checking, savings, and just a short-term U.S. government bond fund. And that's fine. And that might be 2 years worth of expenses. And I think it's fine to think of it that way too. Maybe it's 5 years worth of expenses. But take part of your bond portfolio and allocate it that way as you need to be comfortable and give you that sort of psychological cushion, but all the time keeping your eye on the actual asset allocation you've chosen for retirement, again, in our hypothetical 60-40. So for example, you probably wouldn't want to put 27 years worth of expenses in a checking account. That would probably, for most people, probably not be ideal, and it would wreck your 60-40 portfolio. But I don't think people are thinking that way. I think for most folks, certainly for me, 2 years is probably more than enough, and I'll probably do that. Or maybe it's a year. Maybe for you it's 3. But if that's part of the 40%, again, assuming a 60-40 portfolio, if that cash bucket is part of your allocation of 40% to sort of cash and bonds, I think that's perfectly fine. It gives you a little bit of security, helps you sleep at night knowing that you got a couple of years worth of cash to cover your living expenses. But beyond that, you're simply allocating across your portfolio, 60-40 perhaps, and rebalancing every single year. It's much simpler. It causes us to sell stocks when they're high, to rebalance into bonds, to sell bonds when stocks are down, to rebalance into stocks. Exactly what we want to do. More importantly, it avoids the very thing the bucket strategy says it's designed to avoid, and that is selling stocks when stocks are down. We don't ever do that. We don't ever sell stocks when stocks are down if we're reallocating, rebalancing our portfolio every year. It's as if the bucket strategy is trying to solve a problem that does not exist. And in doing so, it can wreak havoc on our portfolio. So if you've stayed with me through this entire video, frankly, you deserve an award of some kind. I just don't know what that would be. But that is why I think the bucket strategy, I've come full circle. Sometimes I try to be political, just sort of get along with everyone. Okay, that's a strategy you can consider. I really think it's dangerous. I think it's a dangerous strategy and just completely unnecessary. So, USA, what's your name? USA Hicktown? That's why I think the bucket strategy is worthless. It's why I'm not going to follow it in my retirement. Yes, I'll have some cash set aside in the bank, if for no other reason, just practical reasons. That'll be part of my overall stock bond allocation, and I'll just rebalance every year. So that's my approach and my reasons for not really liking the bucket strategy of retirement. Listen, if you have any questions or you have your own perspectives, you have resources you want to share with everyone, leave comments down below. I'll be happy to respond and to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.